Hello, everyone. A very warm welcome to you. I really want to start by saying a huge thank you for choosing to click on this video today and spending some of your valuable time with us.
Absolutely. It's great to have you all watching. We've got a really fascinating one today.
We do. Today, we are doing a deep dive into the source material from Octave Specialty Group. Specifically, we're looking at their fourth quarter 2025 earnings call.
Right.
And if you follow the specialty insurance space, you know this is a pretty massive moment for them. This call marks a really significant milestone because it's officially the first full period of Octave operating as a completely standalone specialty insurance platform.
Yeah, it's the end of a very long, sometimes painful road of restructuring. And it's really the beginning of what they hope is the payoff phase.
Exactly. So here's our roadmap for the discussion today. We're going to start by breaking down the company's prepared remarks. So that's their strategy, the transformation, the financials. Then we'll get into a detailed breakdown of the Q&A session with the analysts, which was actually super revealing.
It really was.
And finally, we'll wrap it all up with the main themes you need to take away.
Sounds good. Let's get right into that strategy.
Yeah. So kicking things off with the CEO, Claude LeBlanc, he opened with a pretty bold statement. He basically said the transformation is complete.
Right.
They're done building the foundation. And now they are this standalone platform focused on entrepreneurship and specialized partnership.
And that is a really critical shift in the narrative.
Yeah.
I mean, for years, the story around Octave has been about becoming something.
Right. Always under construction.
Exactly. And now LeBlanc is saying, we are here. They position themselves as this unique ecosystem that attracts top underwriting talent and distribution partners. So it's no longer about building the house. It's about actually living in it and executing.
And the numbers seem to, well, they do back that up. Looking at the growth metrics in the insurance distribution business, revenue is up 65% over 2024.
Yeah.
And even if you strip out the acquisitions to just look at organic growth, that was 14%, which is not small potatoes.
No, it's incredibly impressive, especially when you consider the broader market headwinds. And keep in mind, that 65% growth figure, it excludes their ventures arm for most of the year.
Oh, wow.
Yeah, and it doesn't even fully count their newest acquisition, ArmadaCare. So that growth engine is running very hot right now.
Which brings up a concept LeBlanc talked about that I really want to unpack for you. He kept mentioning embedded growth.
Right.
It sounds a bit like a corporate buzzword, but he actually put some really compelling numbers behind it.
It's essentially the why behind their confidence right now. You have to think of their business kind of like a nursery. They have 22 MGAs managing general agents in total. But 9 of those, so nearly half, were launched just in 2024 and 2025.
Because they are brand new.
Exactly. They're toddlers in business terms. LeBlanc noted that 40% of their entire portfolio is in these very early growth stages. So the core investment thesis here is that these companies are going to scale up naturally over the next 2 to 4 years.
Right. They don't need to go out and buy new revenue.
Exactly. They just need to let these existing seeds that they've already planted grow.
That makes a lot of sense. And speaking of growing seeds, they also highlighted Octave Ventures, their incubator platform.
Yeah, Ventures is seeing 47% organic growth in 2025. That is the incubator, where they test out new ideas, launch these startups. It's really proving to be a highly effective R&D lab for them.
Okay, let's talk about diversification, because they aren't just putting all their eggs in one basket here.
No, and this is completely by design. They have a really fascinating geographic split. So they've got 9 MGAs based in London and Bermuda, and 13 in the U.S.
And what's the strategic advantage there?
Well, the London ones tend to hit profitability faster. They're just more nimble markets.
Yeah.
But the U.S. ones offer long-term stability. And it's not just geography, it's also a product split.
Right, I noticed that. 28% of the book is accident and health, or A&H, and the rest is property and casualty.
And within that P&C bucket, they're actively balancing casualty against non-cat property. It's basically a hedge. If one market softens and prices drop, the other usually hardens. So it smooths out the earnings ride for investors.
Let's jump back to A&H for a second, because we have to talk about ArmadaCare.
Oh, yeah.
This was the big acquisition spotlight of the call. Why is ArmadaCare such a game changer for them?
2 words: margins and stability. ArmadaCare brings in EBITDA margins of over 40%.
Which is massive.
It's incredibly high for this space. Plus, it's recurring revenue. So by deepening their position in the A&H market with this acquisition, they're essentially buying a high-yield bond that pays out reliably.
Which perfectly balances the more volatile risks they take on the property side.
Exactly.
Okay, before we get to the bottom line financials, we absolutely have to talk about Hammurabi.
Yes.
Please tell me it's as cool as the name sounds.
It really is. It's their proprietary AI platform. And LeBlanc was very keen to emphasize to the analysts that this isn't just a marketing gimmick to sound tech-forward. It is a highly functional tool for their medical stop-loss business.
What does it actually do day to day?
It allows for near-instant risk prediction and pricing. In the old days, underwriting medical stop-loss was incredibly labor-intensive. It was slow. Hammurabi automates all that complex data crunching.
So it's an efficiency play.
Efficiency and accuracy.
Yeah.
They're presenting this as a major competitive differentiator. In the insurance world, if you can price a risk better and faster than the other guy, you win the business.
Fascinating. Okay, let's pivot over to the financials. David Trick, the CFO, took the mic for this section, and he started with a number that I'm sure initially scared some folks.
Yeah, that loss.
Right. A net loss to shareholders of $30 million, which comes out to 84 cents a share.
And on the surface, looking at just the headline, that looks pretty bad.
Yeah.
But this is where context is absolutely everything.
Right. So unpack that for us. Why the big loss in what is supposed to be their breakout quarter?
It is almost entirely noise from the transformation process. You had significant transactional costs just from closing the ArmadaCare deal. You had costs associated with finally exiting their old financial guarantee business.
Which they've been trying to get out of forever.
Exactly. And there's also an impairment of a legacy investment. These are all what we in the industry call one-offs. They're not reflective of the core business that is operating today.
So if you strip out all that noise, all those one-offs, what's the actual picture?
That is where you look at adjusted EBITDA.
Hmm.
And from continuing operations, that actually increased to $1.4 million.
Okay.
So it's positive.
Yeah.
It shows the underlying engine is actually working, even if the one-time renovation costs on the house made the bank account look lower for the quarter.
That makes perfect sense. Now, what about Everspan? That's their specialty insurance segment, the actual carrier side of the house.
This was a major highlight of the call. The loss ratio improved to 62.9%, and that includes their sliding scale commissions. But the real headline number here is the combined ratio.
Right.
It dropped to 99.4%.
And just for anyone watching who might be new to insurance lingo, getting below 100% is the holy grail.
It is. A combined ratio under 100% means you are actively making an underwriting profit. You are taking in more in premium dollars than you are paying out in claims and expenses.
And this is the first time they've hit that milestone this year.
Yep. It completely validates their strategy to reposition that specific book of business over the last 12 months.
And on top of that, they also mentioned some pretty aggressive expense saving.
They did. They are projecting about $17 million in corporate expense reductions. So they're actively tightening the belt on the corporate side while simultaneously growing the top-line revenue.
Which is a great combination. So looking ahead to 2026, they gave some solid forward guidance. What are they promising the market?
They are basically promising the turnaround story is real. They're guiding for a consolidated adjusted net income of around 50 cents per share.
Wow. So going from a nearly $1 per share loss to a 50-cent profit.
Precisely. For the distribution segment specifically, they expect at least 20% organic revenue growth and about $40 million in adjusted EBITDA.
And for Everspan?
For Everspan, they're looking at gross written premiums of around $410 million and about $7.5 million in EBITDA. They're essentially telling the market the messy construction phase is over. Now sit back and watch us make money.
All right, so that covers the prepared remarks. Let's get into the Q&A session, because this is often where the real granular details come out.
It really is. The analysts usually probe for any weak spots in that polished narrative.
Exactly. So we had Mark Hughes from Truist Securities pretty much driving the entire bus here. Let's look at his questions one by one. For his first question, Mark Hughes from Truist Securities asked about the pipeline for de novo, or startup, launches in 2026. He basically wanted to know if they are going to keep up this frantic pace of launching brand new MGAs.
Right. And Claude LeBlanc's response to that was to gently tap the brakes. He told Mark they definitely still see opportunities primarily in the U.S. market, but they are targeting a much lower volume of launches compared to the last 2 years.
What's the new target?
They are aiming for maybe 2 to 4 launches per year. The focus is shifting heavily toward growing the large number of businesses they already launched in 24 and 25.
That makes total sense. Quality over quantity now.
Okay.
Okay, moving to his second question. Mark Hughes from Truist Securities asked about cash flow in 2026. Specifically, he was focused on the cash they're going to need to buy in non-controlling interests because they own minority stakes in these MGAs and they have to buy the rest over time.
Right, and David Trick handled the response for this one. He reassured Mark and the broader market that the NCI buy-in is expected to be less than $50 million for the entire year.
And how are they paying for that?
Trick noted that funding will come directly from cash they already have on hand, plus maybe some marginal additional borrowing. The key takeaway was that it is not going to strain their liquidity.
Good to know. Mark kept going with the financial nitty-gritty for his third question.
He did.
Mark Hughes from Truist Securities asked for specifics on equity-based compensation and net investment income for 2026.
Right, because those line items can really eat into your earnings if they get out of control.
Exactly. And what was the company's response?
David Trick responded that net investment income should be flat to marginally higher next year. But the real good news was on the expense side. He said equity compensation expenses should actually be down a few $1,000,000 compared to 2025.
So again, showing that tighter cost control.
Exactly.
Okay, question 4. Mark Hughes from Truist Securities asked about the seasonality of their earnings. He wanted to know exactly how that 50-cent EPS guidance would be spread across the 4 quarters.
And David Trick's response was that it's going to be fairly lumpy. He summarized that seasonality is still heavily weighted toward Q1 and Q4.
And that's primarily because of the health business, right?
Exactly. It's driven by the A&H businesses like ArmadaCare. They generate about 60% of their total earnings in the first quarter, just due to the nature of health insurance annual renewals.
Right.
Though Trick did add that as those newer startups reach profitability later in the year, it might moderate that lumpiness just a bit, but expect a big Q1.
Got it. And finally, for his 5th question, Mark Hughes from Truist Securities asked for a broad view on the current pricing environment across their 3 main buckets: A&H, casualty, and non-cat property.
And Claude LeBlanc took this response. He gave a very clear breakdown. For non-cat property, they're seeing rate reductions of 5 to 10%. The market is softening there.
But casualty is a different story.
Completely different. Casualty is seeing rate increases, specifically double-digit increases in excess casualty.
And what about A&H?
A&H is the absolute star performer right now. LeBlanc said it is very strong. They are seeing double-digit organic growth, driven by both pricing increases of 10 to 12% and an overall increase in volume.
That is a phenomenal tailwind to have.
It really is.
So that was a really solid Q&A session. It definitely clarified their path forward. Having gone through all of this, the presentation and the Q&A, let's bring it all together. Let's look at the high-level themes.
I think there are 4 main themes you need to take away from this call. First and foremost is maturation.
Right, moving from the startup phase into full execution mode.
Exactly. Management really hammered home that Octave has moved from a building phase to a scaling phase. The heavy lifting of the multi-year transformation is over. Now they're relying on that embedded growth of the MGAs they've already launched to drive value.
Theme number 2.
Technology as a differentiator. We spent time on Hammurabi, and it's clear this is not just a buzzword. They are proving that proprietary AI can drive actual, tangible pricing accuracy and margin expansion, especially in that medical stop-loss business.
It's turning underwriting from an art into a highly precise science.
Exactly.
And theme 3 has to be the financials.
Financial turnaround. You just cannot ignore the sheer scale of the shift here. Moving from a reported net loss in Q4 25 to guiding for a solid profit of 50 cents per share in 2026.
It signals a lot of internal confidence.
It does. It tells you management believes the one-time transactional costs are firmly behind them and the core engine is highly profitable.
And the final theme?
Strategic diversification. This is their safety net. The way they've balanced the volatile, high-growth U.S. casualty market against the highly stable, high-margin A&H business, especially with ArmadaCare, is brilliant. It acts as a massive stabilizer for their future earnings against whatever the broader market does.
It really does seem like they have set the table for an incredibly interesting 2026.
It's definitely a show-me year. They built the machine, now they just have to prove it runs perfectly.
Absolutely. Well, we will be watching very closely to see if they hit that 50-cent target next year. But that brings us to the end of this deep dive into the source material for Octave Specialty Group. I want to sincerely thank you again for watching this video.
Yeah, thank you all for your time today.
If you found this breakdown helpful, please do us a favor, click that like button, Share the video with a colleague who might find it useful, and subscribe to the channel. We have a lot more great content coming down the pipeline, and you definitely won't want to miss it.
And before you go, just something to chew on. If Hammurabi is this successful at predicting risk and medical stop-loss, how long until they start adapting that AI to tackle the complexities of their casualty book?
Ooh, that is a billion-dollar question. Stay tuned, everyone. See you next time.